You're listening to the Washington State Real Estate Investing Podcast. This episode brought to you by the Easy Home Buyer, serving the Spokane and Coeur d'Alene area. If you're an investor in the greater Spokane area looking to connect with wholesalers, look no further than the Easy Home Buyer. Click on the link in the show notes to be put on their buyer list today, and check out episode 17 with the Easy Home Buyer founder, Chad Young. I'm currently looking for a co-host for the Washington State Real Estate Investing Podcast. Being a podcast host is a great way to get your voice and company in front of others and make connections that can help grow your company even further. And it's fun. If you're interested in being a co-host of this podcast, email me at jeff@wsreip.com. Well, hey folks, it's great to be back with you all here at the Washington State Real Estate Investing Podcast. In today's episode, I chat with Paul David Thompson, an author and full-time real estate investor. Our conversation really focuses on one essential aspect of real estate investing: know your strategy. And that brings me to today's investor highlight, which is know and understand your investment strategy. When I talk with other real estate investors, it usually comes down to people saying their strategy is flipping homes or short-term rentals or long-term holds, which is fine. But when we talk about having an investment strategy, what we're really talking about is the details within that strategy. Just because you say that you are a flipper, a strategy is knowing what type of houses you are looking for. What type of houses do you like to flip? Are you a full rehab flipper, or are you more of a lipstick flipper? If you're a long-term holder of real estate, are you actually somebody who is using the BRRRR strategy and looking for investment properties that you can add value to? Or do you like to invest in turnkey properties? If you're in the short-term rental space, are you investing in places that are used for vacations, or are you investing in places that are where people travel to and from to maybe work? The more detailed you can get not only on your strategy, but also getting into the weeds and understanding what your strategy is essential so that when a property comes available, you can quickly determine whether or not it fits inside your strategy. I'll use us as an example. We are long-term hold investors who look for small multifamily properties that we can add value to by doing either full or add-on renovations, then rent and refinance out of that. And while everything is said and done, we want a cash flow for a minimum of $200 a month. By being very clear on exactly what we're looking for, we can quickly determine if a property matches our criteria, and our real estate agents and those that are looking for properties for us know what we're looking for as well. If it doesn't have real value add, we're not interested. If it can't cash flow for at least $200 a month after we refi out of it, we're not interested. This allows us and our team to focus on what it is we're really looking for, and then we stick with it. When we're putting in offers on a place, we know our numbers. We will not go above what we believe at the end of the day will cash flow for less than $200. Whether you are just getting started or you've been in the game for a while, knowing your strategy and then implementing your strategy is how you have long-term consistent growth. So what's your strategy? Does your team know your strategy? Do we all agree on what our strategy is? Without a strategy, you open yourself up to making the wrong decision or wrong purchase. That brings me to today's conversation with Paul David Thompson, a real estate investor, author, and podcast host supporting other investors in growing and scaling their business. Enjoy this conversation, and with that, on with the show. All right, welcome back to the Washington State Real Estate Investing Podcast. I'm so excited to be here today with Paul Thompson. He is the podcast host of Ready Investor One, which I love that name, seeing that I love Ready Player One, the book.
Mm-hmm.
I'm a big tech guy myself, so it's great. Paul, thanks for being on the podcast. Just let's get started a little bit about your background and kind of what does your portfolio look like today?
My portfolio today is a portfolio of single-family properties in Little Rock, Arkansas, where I live and do the the single-family portfolio. But I've branched out into multifamily, and I have development projects in the Dallas-Fort Worth area.
Oh, cool!
That's kind of like my new thing. And then I've just launched a 506 or Reg D 506C fund for accredited investors. And so what I do is we lend to investors. And so I raise capital in the fund, pay investors out, and then keep money spinning for the investors while allowing operators to still stay liquid and do their projects.
Ah, very cool. Very cool. So started to expand out. So you got started in the single family real estate business and kind of expanded out. And I think that's, we focus here a lot on Washington State real estate investing. And I think a big part of that is just understanding the mindset. And that's really what I wanted to have you on for, is regardless of where you're investing, the mindset behind an investor goes across state lines. It goes across international lines. So as we get started here, what are some of the things that you do? And maybe let's focus in on first on your single family properties. What is the due diligence, or how are you evaluating potential real estate investment opportunities? What's kind of the due diligence that you go through?
So first and foremost, I invest in single family for cash flow. Appreciation is a nice thing to have, but I think of that only as the cherry on top, the bonus. So if it doesn't underwrite as something that I can cash flow for, then it's just I just move on, or I make an offer such that it will cash flow.
Right.
And then in this cycle, and especially in Washington State, the prices are just so competitive that it's probably really hard to find cash flow. So one of the adjustments that I would make there is doing a lot of creative financing, like buying subject to. A bunch of properties right now would have really good subject to opportunities. I think owner financing is the solution right now. And people have not been thinking about that for a long time because interest rates have been so low. But now it makes a lot of sense. There will be a lot of owners that will consider 5, 6, 7% interest, or maybe perhaps lower, because now interest rates are so much higher.
Yeah. Do you find that whenever we're investing, and we've talked to a lot of investors, that when you're doing due diligence on a property, you either have to kind of go into it with, is this an appreciation hold, where maybe I'm not going to cash flow, I'm just going to try and break even on this property and hope for appreciation in maybe like someplace like the greater Seattle area.
Right.
Or am I going to go out into some rural areas? Even around here, there's some rural areas where you could focus on cash flow. You can still buy a house for $200,000 and make it cash flow. Yep. Do you find that you have to be either in trying to get both of those, happened for a little while there, I think, but I think when you're doing due diligence, you have to really kind of focus in on one of those two buckets.
Yeah. What is your strategy? And even if you're going for an appreciation play, you need enough cash flow to be able to hold on for dear life,
right,
and cover especially if you're financing it. So if you're not making a return at least equal to your interest rate, then why are you buying it? Because you're really playing, you just don't want to buy an alligator. So I'm always very careful to not get into a deal that I have zero or little confidence that would cash flow.
Now, talk a little bit about, as you move into the multifamily space, is that same strategy applying in your multifamily space? How is it different than the single family space?
Well, the challenge with multifamily is that it's just difficult to do big multifamily projects by yourself.
Right.
You pretty much have to bring in some sort of partner. Most people don't have the net worth. They don't have the resources in order to take down their own multifamily. So it really becomes a team sport in a way that you just don't have to do in single family if you don't want to. So it kind of depends on your preference. And when I'm looking at underwriting it, you absolutely want to be able to cash flow. There's no way that I can see a reasonable approach to buying up a operating multifamily project that doesn't have cash flow, because you have to pay your investors somehow, right?
Right.
So you may be doing a value add, or you may be turning something around that's not cash flowing, but you have to have a path towards cash flow, which may take 6, 12, 18 months.
Right. So it's just, so your cash flow game has to be longer, and you have to make sure you have that long tail to get out there. Yeah.
Yeah.
I love that. How do you kind of balance the risk return factors in your investment decisions, and thinking about today's market as the market has kind of shifted and we see investment come up? I love the idea of owner financing. I agree with you. I think all of a sudden it's back on the table, and people who are new to investing, when you're used to getting stuff at 3.5% interest rate. You're now looking at 6.5%, 7%, can be a little bit crazy. And there's this idea of home, owner financing. What are other strategies kind of in today's market that you're looking at, or that you think real estate investors need to be considering?
Well, so it's just a really important lesson to remind yourself of is like we all have what we call recency bias, and we think what just happened is normal. And what we've seen over the last 12, 14 years since 2008 is not normal. That's just what we were used to. And probably what we're seeing now is closer to normal that's ever been. If you averaged interest rates for the history of since the Fed's been around, let's say, this is probably pretty close to normal.
Yeah.
And it trained us some bad behavior. And it's a really interesting story right now that something like I'm guessing on this number here, but 95, 97% of all loans that are out right now on a single family house are under the current interest rate now.
You're right.
So it creates a very interesting scenario when you're buying into the market at what you know is the high water mark for the last 14 years.
Yeah.
And like that's the big risk. And everything I'm doing now, especially if you're using commercial loans, is you really want to underwrite such that knowing that your interest rate is likely to go up in the next few years. I'm not saying it always will, but you want to plan for that. Over the last 3 or 4 years, people haven't been thinking that way. And so now they have balloons that are popping every 3-5 years on these commercial loans. And now the properties don't cash flow.
Right.
What do you do? So that's something I really want to watch out for. Is I don't want to be in a place where I think we're at the peak right now, but then 3-4 years from now, when my balloons are coming due, I can't afford the recast of that loan when interest rates are at what, 10? I mean, I don't know.
Yeah, right. We don't
12?
know what they're going to be, right?
Right.
Yeah. I love that. Have you been following the collapse of Silicon Valley Bank?
I have.
How excited are you that you're investing in real estate?
Very, very. And I have a lot of friends that run crypto funds, and they are really bullish on crypto even still. And it's a really interesting conversation about what's happening in the marketplace. I think a lot of people are putting this out there, that the U.S. economy, or the Treasury and the Fed are making a play towards making our currency digital, like truly digital, not just a fiat currency, but a digital fiat currency.
Yeah. And I love following it just because every time I'm reading more and more, I'm just like, man, and all my properties are just keep cash flowing. How great is that, right? People just keep paying their rent because they need a place to live. And so it's great that all these things can happen behind the scenes. What advice do you have for maybe people who want to get started in real estate? And I'm thinking, this is a great time where I think we're going to be picking up again some new investors when something like this, something like these banks collapsing in the market, all of a sudden is going to push people to be maybe diversify their portfolios a little bit more, thinking about real estate a little bit more. What advice do you have for someone who is maybe wants to get started into investing in real estate?
Well, it's like the old Chinese proverb. I think it's Chinese that says, the best time to plant a tree was 20 years ago, and the second best time is today. If you're not in real estate, find a way to get some exposure to real estate for some of the reasons we've already mentioned. Like it's cash flowing, it tends to hedge against inflation. It's a real thing. Like it can't evaporate. Like you can go out and touch it, and it has some utility to it. And so I always like to say like this is your wake up call. Like this is the moment when millionaires, the future millionaires of this generation will be made, is during this cycle. Whatever this cycle is, we're not really sure yet.
Right.
But I remember in 2008, I was not a real estate investor. And I remember thinking, I'm missing something. Like I don't know what to do. And so I spent this few years after that kind of studying, and put it off until 2015 before I bought my first property. And I so regret not having started earlier. Just one property, just get something, do it with a partner even, just get some exposure to it, see the mechanics of it. And once you get a couple of those rent checks in the mail, you're like, hey, wait a second. Because I think one of the things that we should all be thinking about is we need to create our own personal economy, whether that being a gig type service, whether that being a real estate investor, whether that being your own business. Relying on the government, relying on employers to be that safety net for us is, I think, a mistake. And you need to create a scenario that you're in the most likely scenario that when things don't go to plan, you're still getting paid. And I don't know anything better than rental real estate to do that.
Yeah. And I guess I've been fortunate enough that I've never had a 401k. I've never had a retirement with any company that I worked for. So I've never thought of, I'm relying on my company or I'm relying on these investments. I've always had to, because of, the companies that I've ran, being an entrepreneur for so many years, that's just it. And I have a hard time because it's just the mindset that I have. Everything exactly what you're saying. I love the idea of getting in, and I can't agree more. Like today, any day is a great day to get into real estate. But I think one of the things, and I'm hoping you can touch on this, is that there's multiple different ways for you to get in.
Right.
A lot of people think, well, I don't want to own a house and have to go clean toilets and find renters and do all that. Great. If you don't want to do that, then maybe not investing in your own single family house is.
Right.
But like you said, you can go and partner on a complex, or you can become an investor in something like your fund. Maybe talk a little bit about, like, if I've got money sitting around, how much money do I need to invest in this fund? Because you're still investing in real estate, but you're investing in it with partners. There's more, maybe a little bit more security there. Maybe talk about that as a route for new investors as well.
Yeah. So there are people who are they want exposure to real estate, but they just don't have the time or energy. And you can invest in real estate passively. There are national scale funds that you can invest in. There are REITs you can invest in. And then there are more boutique funds like what I run, where you can invest. There's they tell you ahead of time what they forecast the return is going to be. It's called a preferred return. It's not guaranteed, but I don't get paid. Any fund manager doesn't get paid. The GP, the general partner, doesn't get paid until the LP gets paid first. That's what a preferred return is. So the preferred return gets paid to the investors. After that, the GP and the LP, limited partner, general partner, split the profits. And I don't know of a scenario that makes more sense for a passive investor to get a exposure to real estate, have the best likelihood of a good return that is also backed by a hard asset. There's no other thing out there like that exists. And what's crazy is the LPs get the bigger slice of the pie. The GPs aren't the one making most of the money. They're the ones doing the most of the work, but they're not the ones making most of the money as the LPs that are.
Yeah. And so right now, what's an LP in your fund? What are the rates? What do the rates
12% pref.
12%.
Yep.
Oh my gosh. Like, you just think about that. You put your money in, there's no savings account. that is saving up at 12%. And even if you're invested in, the stock market, 12% return on your money is way above what most people aim for. So
it's above the historic average of the S&P or most index funds you have access to. And I like to think about it in this idea of if I can make a 10% return, on average, the rule of 72, I'll double my money every 7 years. If I'm making 12% return, I'm doubling my money every 6 years. And what happens when you start looking at 3 or 4 cycles of doubling your money like that? You can take $100,000 and put it in, and it becomes $800,000 in 4 cycles.
Yeah. Wow. That's so exciting. I love it. You talked about that you have, your single families in one location. You're now multifamily in another location. What are some of the ways that you stay informed in different markets, and how do you adjust your strategy kind of based on those markets? Like, I'm sure there's a reason why you were like, Dallas, Fort Worth is where I want to have multifamilies, but I love my single families here. What are some of the market, I guess, data that you look at to make those decisions?
So I read everything I can get my hands on. I think I've subscribed to something like 100 different newsletters. I don't read every word of every single one of them, but I scan them. I read what's happening in the market. Like Charlie Munger is known as his grandkids refer to him as the grandfather with a book with ears.
Yeah.
His nose is always in a book. And so I'm always taking in something. I'm reading the Fed's information. I think is super interesting. And I'm, the Wall Street Journal, I have a subscription to those kind of things. And I like to read the local trade rags of wherever I am. So I'm in Little Rock and I'm in Arkansas. So we have a Arkansas Business Review. I subscribe to that. In Dallas, there's a few different trade rags that you can subscribe to. Some are free, some aren't. But I want to know what's happening. And it's super interesting. You can read some of these local newspapers. Some are digital, some are physical. And there are actually still only physical newspapers that come out about this industry. It's crazy, especially in Dallas, which is weird. And I chose Dallas because I saw that it is just a huge growing market. There's tons of new jobs coming there all the time. And if you look at the Fed's data, and they have all these different regions, the Texas region is hands down just like so much further above as far as just growth than all the other regions for the Fed. And so it's basically Texas, New Mexico, but Texas is what's driving it, right? And this market is it's a growing, strong market. And I like to find a rising tide. So I'm looking at information where can I don't have to be that smart. I just like to be there. And appreciation helps me. The likelihood of appreciation helping me is very high.
Yeah. I like that. Can you maybe share an example of a success or maybe one of the deals that you've done recently?
Yes. So my favorite type of deal is where I'm the lender. So I do a lot of land loans now. And so somebody else goes out and finds does all the work, sends all the mailers, they do all the negotiations, and I make as much money or almost as much money as the land flipper does. And I'm taking a lot less risk. So I'm exposed 50% loan to cost. So let's say it's a $50,000 loan. The project's worth $120, just bare land, just recreational land in the middle of Texas or Florida or North Carolina. Those are our three biggest states as far as loans go. And we did one in Washington not long ago. It's the first time I did a deal in Washington, actually. And it was just a piece of bare dirt in the middle of nowhere, probably had a bunch of trees in it if it was in Washington. And I've never seen it. I've never been to the state of Washington, honestly. And I made like an 18% return on that deal. And I took very little risk in the scheme of things. And I was able to pay my investors 12%. And then we split what was left.
Wow. That's fantastic. That's great that you flipped the switch and on the loan side of it now. So
yeah, I mean the money's in the money. There's the reason why every building or the biggest building in every city you go to is a bank. There's a reason for that. Yeah, there's money in the money.
Yeah, I like that. There's money in the money. That's great. Paul, thank you for spending some time with us today. You have your podcast, Ready Investor One. Talk a little bit about that. What do people get over there on that show? I'm
glad you brought it up because just in the last month, I have actually rebranded that to My Freedom Foundry. So when I first sent it out to you, and for the last few years, it's been called Ready Investor One. And the idea behind that, I was helping the individual investor invest for themselves and create their own personal economy. But no one knew what I was talking about. Unless you've read the book, you didn't know what I was talking about. So I called it My Freedom Foundry because we're trying to forge the financial freedom. And my mission in my consulting business is to change the family trees of 1,000 families. And that is kind of the whole purpose behind it, is so that we can all think for ourselves, wake up and see that we need to be preparing for ourselves and not relying on third parties or the government institutions to rescue us. Because, I mean, we need some of those things. I'm not saying I'm not an anarchist or anything, but I don't like being beholden to a boss that says I can't go on vacation. I want to call my shots.
Yeah. Yeah. Awesome. Where else, if people want to reach out to you, where's a good spot for them to reach out to you?
Yeah, the best place to find me is my website, pauldavidthompson.com. And those are spelled about the way you would expect. I have the curse of a common name, but Paul David Thompson, I use all three names to be unique. And you can also find me like that on Instagram and YouTube, pauldavidthompson.com.
Awesome. Well, thank you, PaulDavidThompson.com, for being here today. Thank you, Paul, for stopping by and spending a little time with us. Again, we will have links to everything in the show notes, the podcast, the website, everything for you to go over and follow Paul. Some great content that he is pushing out. And just, again, another place to go to learn, to think about and learn from other investors and what they're doing in the market today. So thanks, Paul. Thank you for listening to today's episode. I'm always looking for people in any part of the real estate investing arena to have on the show as a guest. If you or someone you know wants to be on the show to talk about what they do and how they support real estate investors or are a real estate investor themselves, you can head over to WSREIP.com and click on the contact page to fill out the form to be on the show. Or email me at jeff@WSREIP.com. and we'll get you scheduled to be on. Thank you for listening, and until next time, we'll see you on the network.